Welcome to Short View Trends, your morning market here for Monday, 11th of April. It's 9:30 a.m. London time. What matters today and this week for traders? Well, the drama really started to shift last week. Equity markets, which had been the main part of the action in the second half of March, started to stabilise, trading within a broadish range, but a reasonably sensible range with volatility remaining reasonably quiet. As you can see the chart in front of you now, the S&P 500 remained, broadly speaking, within its 50% to 61.8% Fibonacci retracement levels. And with that, the VIX quietened down, and the VVIX, which is the volatility of the VIX itself, stayed below the 200-day moving average, way below where it's been in recent weeks as the markets were kicking off in February and early March, and much more subdued place. And of course, the VVIX tends to lead the VIX. So good, low, subdued levels on the VVIX is encouraging from the VIX point of view. So the drama, as I said, moved on and shifted, and it shifted to the bond market. And the bonds sold off dramatically. The yields picked up sharply. As of this morning, overnight in Asian trading, we got up to 2.78% yield on the 10-year US 10-year Treasury, up over 100 basis points in 6 weeks, with a lot of that movement happening just in the past 5 or 6 trading sessions. And reflecting that, the volatility of the bond market, the MOVE index, which is the equivalent of the VIX for equities. You have the VIX volatility index for the equity market. You have the MOVE for the bond market. It's implied volatility from options. And you can see on the chart in front of you now, it's stayed at high levels that it's been at in recent weeks, really dramatically high levels compared to recent years. So the drama shifted into the bond market in terms of the volatility, and this matters for equities. You know, as we like to say, and as we said many times before in these videos, the world of global financial markets is one giant puzzle. All parts affect all others, and actually most of it starts with the bond market. And indeed, if you dig into the detail of the equity market, a lot of the sectors are linked to bond yields. So the defensive sectors, real estate and utilities, are classically called bond yield proxies. Where the bond yield goes, they tend to follow. Equally, staples, fairly similarly, often like that as well, another defensive sector. And of course, tech, a play on real bond yields. And real bond yields are a subcomponent part of normal 10-year Treasury yields that we talk about. And real bond yields have been pushing this 10-year Treasury yield higher in recent weeks, and they've been bringing pressure to bear on the tech sector in this year, 2022. Rising real bond yields often, although not always, but often a negative for the tech sector. And that's been the case this year so far. So bonds and equities are deeply linked. Commodity prices are deeply linked to the raw materials, resources sectors in the stock market. Industrials, about the economic cycle, they're linked to bond yields that way. So the whole global financial landscape is one giant puzzle. And as I say, a lot of it starts in the bond market. And we talk about how this puzzle fits together, how bonds impact equity markets and equity sectors in our daily rag that we publish each and every day on the website that's available to subscribers, or available also for a free trial. If you're interested, please click on the link below and sign up for a 7-day free trial. Simply enter your name and email address, no credit card details required, and we'll send you the daily rag for free for 7 trading sessions. And we also touch on those matters in these videos, which we publish 2 or 3 times a week, Monday, Wednesday, Friday. And these are of course free. Simply click on the subscribe button you see in front of you now and like them and share them. But in terms of this equity market, we're focused on our 1 to 2 week market timing models that we published each and every day in the daily rag. And here below is one of the examples of those models, the short-term risk appetite scoring system. This is like a greed and fear model. And it's nicely picked up the movements in equity markets, the 1 to 2 week swings over recent months. And you can see it's come down from very high greedy levels not too long ago, and it's working its way pretty rapidly towards buy fearful levels. So when the market's fearful on this model, you want to buy it. When the market's greedy, you want to sell it. And this model is quite close to giving us a nice buy signal. So to see how we're playing this market, please see today's daily rag. As I said, available to subscribers via the website, or if you want a free trial, simply click on the link below and sign up with your name and email address. So what are we watching this week? Well, it's a shortened trading week because of the Easter holiday for most of the world's financial markets, particularly the developed markets in Europe and the US, Australia, Canada, and so on. And in Hong Kong, Singapore, places like that. Shortened week because of the Easter holiday on Friday, Good Friday. But there's still lots going on. We've got some inflation out of the States, headline and core CPI Tuesday, inflation out of the UK as well. We've also got some Chinese aggregate total social financing we've had out earlier today. It was a pretty chunky number as well, so that's important. Markets will be digesting that. Added to which, we've got the ECB later this week on Thursday with a press conference from Lagarde. Will they start playing catch up on the tightening we're seeing come out of the Fed or not? Will they hold the course? And then on top of that, you've got Michigan sentiment back end of this week. And then, of course, also we're starting quarterly earnings seasons out of the States in earnest with the banks this week. JP Morgan, Citi, Wells Fargo, one or two others. They'll be watched very closely. It's the beginning of the US quarterly earnings season, Q1 earnings. Let's see how they look. This will be important for equity market direction with those earnings coming out this week and over the course of the next few weeks. So that's it from us. That's your morning market hit for Monday, 11th of April. Thank you for listening. Please do subscribe to these free videos. Simply click on the subscribe button and you'll get a video Monday, Wednesday and Friday most weeks. Or follow us on LinkedIn, Twitter and or Facebook. Thank you for listening. Stay safe. Trade well.